I want to now turn the floor over to Tony Brown, who is now going to introduce the next panel and lead the session. So, Tony, it's over to you. Thank you.
Thank you very much, Peter. And hello, everybody. I'm Tony Brown of the Trade Advisory, the international trade and finance consultancy based in New York, details of which you can find in the event materials. I am delighted to be the moderator of this panel, Assessing Fraud and Other Risks in Payables Finance. A warm welcome to all the participants, and especially to my dream team of panelists. Frankly, they are best in class in payables finance, and we're fortunate to have them to share their experience and insights. So very briefly, let me introduce them. Their full bios are in the brochure. Ladies first, Monica Martin Blanco. Now, I don't know if you can see her, but say hello, Monica. She's probably on mute.
Hello, everyone. Sorry.
There you are. And she's a consultant building FCI's reverse factoring platform and helping the World Bank, ADB, Asian Development Bank, and central banks to develop theirs. Prior to that, she had an illustrious career at Santander. Tom Dunn is chairman of Orbion, one of the oldest and best respected supply chain finance platforms in the business. He also heads up Raglan Capital, a private equity firm, leveraging his extensive career at JP Morgan in corporate finance, debt capital, and credit markets. Sean Edwards appears today in the role of chairman of the International Trade and Forfeiting Association, otherwise known as ITFA. He also heads up the legal department in London for SMBC and helped write the rule book for and the definitions of forfeiting and supply chain finance for the International Chamber of Commerce, for whom he also spearheads efforts to promote digital trade finance instruments. Not sure you get much downtime, Sean. And finally, John Monahan, who is Citi's global head of working capital advisory, treasury, and trade solutions, capping a 15-year career during which he headed Citi's working capital finance and supply chain finance solutions globally. Citi is widely regarded as one of the leading, if not the leading, supply chain financier. Great to have you all on the panel. Over the next hour, including hopefully some time for Q&A, which we hopefully will get to, we'll address a wide agenda, as you can see. We'll set the scene by defining what true payables financing is. We'll identify the risks. We'll talk about how providers and investors can protect themselves. We'll consider whether more rules are needed. And then we'll look at credit insurance, and finally, how technology can play a part. And so without further ado, let's dive in. I want to talk about this family tree a little and where payables finance fits in. Now, the Global Supply Chain Finance Forum created a very useful set of definitions a few years back, and actually it's in the process of updating them now. And you can see that at the top of this chart, there are some super categories with some lender definitions on the left and non-supply chain finance activities on the right. Those are not within the scope of our discussion. I'm sure you're familiar with all of them, but we're not going to talk about them today. What we are going to talk about is we're going to focus on the bottom left-hand side of the family tree, the receivables purchase branch of the family. And there, the difference is that we are talking about receivables purchasing. There are various different techniques there, receivables discounting, forfeiting, factoring, and there on the right is the one that we're talking about, payables finance. Much different from the family, the cousins on the right of the family tree, the loan advanced based programs, the loans against receivables, the distributor finance, inventory loans, and free shipment finance. And clearly, there's some gap in between, and we're going to be discussing that because that's a fertile ground for things that certainly happened in the case of Greensill. So let's zoom in, if we may, and I'm going to ask John, if you'd be kind enough, John Monahan from Citi, to just lead us through what differentiates payables finance from factoring. Over to you, John.
Well, thank you, Tony. And again, if we can go to the next slide. looking at as Tony mentioned, supply chain finance has a number of different components. Today, I'd like to give just a brief overview of the differences between payable finance and factoring. While not all encompassing, these are the salient points that differentiate payables between factoring. So first part up, what's driving each? And in terms of payables finance, the distinguishing factor is that it's buyer-led. And on the factoring side, it's very much supplier-initiated. And what I mean by that is the buyer, principally why payables finance, why is it buyer-led? It's really to improve their working capital and helping improve and or injecting liquidity to suppliers. And while a main benefit from a buyer point of view is the ability to facilitate terms extension. And on the factoring side, again, it's really the supplier looking to get liquidity through receivables discounts or sales. When we go to the buyer risk exposure, it's really concentrated on the obligor, the single buyer. And on the factoring side, very much one supplier with generally multiple buyers. And I'm running through a lot of this fairly quickly, but what I'd like to just highlight the main distinguishing characteristics. Another important feature with respect to payable finance is whether or not it's secured and or committed versus factoring. Factoring is generally a secured line to support liquidity for a supplier. With respect to the payables finance, it's really an uncommitted line, and funders do not have the obligation to fund the supply chain or to do supplier finance or payable finance to the suppliers. Important distinguishing characteristic when we look at the risks and the frauds, because what happens in the event of an obligor or a buyer having some financial difficulty and or disruption, and we'll go into that more later on in today's session. Another important feature is, since it's buyer-led, the ability to have transparency and understanding of what that commercial invoice and or obligation is. So it's generally, in terms of the documentation, unconditional. You'll see in the documentation, unconditional, irrevocable, approval from the buyer to a funder with respect to the actual commercial obligation. On the factoring side, not necessarily disclosed, so there's may or may not have items with respect to whether or not the buyer has approved something. Again, from a risk and a fraud perspective, we'll go into that in more detail. Advance rate, since the buyer has approved the invoice, generally 100% versus factoring, which is not necessarily approved. You generally look at 80 to 90%. So from that point of view, we'll go into what are some of the risks. Recourse to the supplier. What happens with respect to, what is the benefit of payables finance? The buyer is selling a receivable without any putback on themselves. There are some receivable purchase agreements with respect to fraud and potential putback on that respect, which we can go into in more detail. Payment terms, one of the distinguishing characteristics of both payables and factoring, it's a completed commercial transaction. So an invoice has been presented to a buyer. The buyer has accepted that invoice on the payable finance side, so it's a completed transaction. On the factoring side, it's again financing post-shipment on a commercial transaction of goods and services. The funding structure, that's where, again, from a risk perspective, the funding can be done through an FI and or the FI can and or an arranger can also look to structure the deal and then pass it off to investors. Very important in terms of this conversation. What are some of the risks in terms of how to enhance these propositions with respect to ultimate purchasers? Receivables purchase agreement. One of the things distinguishing payables finance versus factoring is, and we have Tom Dunn from Orbian, is it's very much facilitated by technology and fintech providers in terms of the voluminous amounts of invoices and number of suppliers and the automation on the payment side. So it also facilitates in that respect. Whereas factoring, it may or may not be automated, and it's a supplier dealing with a single funder. From an off-balance sheet point of view, the payables finance is really about supporting a buyer's need to maintain an accounts payable treatment, as opposed to classifying the payment obligation as debt. And there's a lot of discussion around the accounting of payables finance and disclosure, which
and I think we'll be talking about that actually in a minute.
So look,
thank you, John. Thank you.
Those are some high-level things. The importance is really when you look at the documentation. And lastly, on the payables finance side, it's contractual between a funder and a supplier with a receivable purchase agreement, and likely an agreement with the buyer and the funder with respect to ensuring that the payment obligation is there, as well as the commitment to pay a certain amount on a certain date. I'll turn it back to you.
Thank you very much indeed, John. That was a swift cook's tour through the differences. Thank you. Let's change topic a little, or focus on rather the payable side of this equation, and let's talk about the risks for default, which include fraud and other things. In our discussions before this panel, we talked about $7 billion worth of potential losses to funders, the taxpayers, and others from the Greensill event. And it's quite clear that there were two types of risk there. One was fraud, and the other one was credit risk. So if we may, let's focus first on fraud. And Tom, can I ask you to kick off the discussion here for the next 8 or so minutes on the fraud risks, the opportunities for fraud in that gap that we discussed earlier between payables finance and factoring, and other aspects of the Greensill case that were problematic. Over to you.
Sure, thanks, Tony. Thank you, John, for that introduction. I think it's fair to say that other things being equal, borrowers would generally prefer to have longer term drawings, longer term loans, and at a price that is somewhat lower than would be implied by the risk of credit loss on their or the risk of loss on their credit. Lenders, by contrast, would generally prefer to be the other side of that equation. They would generally prefer to have shorter term assets and to be paid a return that is slightly higher than the implied credit loss on the exposures that they're taking. This is fine. This is banking, lending 101. And this is a tension that is actually incredibly helpful. It's very useful. It's what sits at the heart of the banking industry overall. And within the banking industry, this credit loss and timing mismatch equation is resolved through the various capital and supervisory obligations that banks and other deposit takers have as they participate. The challenges arise when both sides think that they're getting the equation is favoring them. So borrowers think that they are getting longer term funding at relatively cheap pricing, and investors think that they are getting relatively short term, easily liquidated assets at higher returns. And the problem is that these two things only get reconciled where both sides think that they are getting something, that they're the winners in this equation, when there is a misrepresentation by somebody in the middle that is probably not telling either side the truth, the whole truth, and nothing but the truth about what they're getting. And that, in essence, is the heart of the Greensill fraud. borrowers, whether that was Sanjeev Gupta and the Liberty Group, or Jim Justice and Bluestone, or Katera and some of the other SoftBank, the Vision Fund investment companies, they thought that they were getting relatively low cost financing that had the advantage of some working capital advantages. But for credits like that, whether it was a payable or a debt didn't really matter. What they cared about was the fact that it was liquidity, it was relatively cheap, and they thought that it was relatively assured. On the other side, you had investors, and those really fall into two main categories. There are the depositors in the Greensill Bank, and there are the note holders in the various Credit Suisse and GAM funds. They thought that they were purchasing investments that were short-term, readily liquefiable, were going to be self-liquidating. They were money market equivalent type of investments that had very low credit risk because of the underwriting that was going in, either the direct underwriting, that the names that were touted were often very good names like Vodafone and Airbus, although they accounted for a very small component of the ultimate asset base, or the credit insurance that was much described. But they thought they were getting low credit risk, low maturity, and an outsized return, albeit measured still in basis points rather than percentage points. But they thought they were getting the better side of the equation. Unfortunately, both sides were ultimately let down by the fact that what was sitting in the middle and the story that Greensill Capital was telling, they were not telling either of them the truth, the whole truth, and nothing but the truth, but was relying on a kind of a suspension of disbelief in the middle around the fact that if it was called receivables finance, if it was called supply chain finance, then it must be short term. But if it's got a committed facility or it's against future receivables, then maybe it's not so short. So everyone was kind of caught in the middle of ultimately a fraudulent misrepresentation as to the credit risk and the maturity profile of either the asset that they had on the investor side or the liability that they had on the depositor or note holder side.
There's also a little bit of misbehavior, if I'm not mistaken, on the seller side, because if you look at the GFG invoices to Trafigura, $30 million per instance, Trafigura said, wait a minute, we didn't do that. And yet those were included in the fund. So there's a little bit of seller misbehavior. And if you look at, Abem Goa, another case where there was a complete abuse of reverse factoring, if you will, with buyer and seller agreeing to repo type transactions. I think you know a bit about this, Monica. And that was naughty as well. So it's not just Greensill, it's a whole compendium of issues.
Tony, I agree with that, and it's certainly there are ripples that spread out all the way from this. I think you could, though, in the case of the Liberty Gupta receivables and the way that they may have been, I think you can still put that back onto the shoulder, very largely onto the shoulders of Greensill Capital, on the basis that their credit underwriting processes were fraudulently flawed in terms of the way that they were describing to participants what was in there and what was being covered. The fact that they may have been the victim, or they may have been whatever was going on the other side as to the creation of those invoices, is kind of all becomes part of the fact that credit was not being accurately described to the people that were ultimately putting up the money.
Anyone else got comments on this? Sean, I see you.
Yeah, I do, because I mean, I agree with pretty much what Tom said, but I think you do need to distinguish between what I've described as a sort of the Jekyll and Hyde that was inherent in Greensill. So I mean, I think Tom is right. There are certainly misdescriptions going on, not just to investors. Actually, just yesterday, news stories about and we'll get to it in more detail in a moment, but the credit insurance, about whether or not they will pay. Because what they were covering actually was a receivable and not this future receivable, which is in fact not a receivable at all. There's going to be a hell of a fight about that. But clearly, that if that's what the beneficiaries of that insurance thought they were getting, there's been misdescription somewhere. That has to be true. And if there's been misdescription, or false representation to the insurers, they're in an even worse position, because the supposed risk mitigant that was in place isn't there because the terms of the policy are not met. But and so therefore for those names, that were apparently elevated to a much higher credit status because of structuring, because of credit insurance, definitely there's a whole can of worms there. I think though the other part, the Jekyll, I think that was the good one, wasn't it? Mr. Hyde was the bad guy. The Jekyll of it are the investment grade names. So I think it's important not to conflate the two. I think there was very little misrepresentation. I mean, I can tell you this from personal experience because my day job as head of legal at Sumitomo, I've looked at the program documentation very carefully. This was the traditional business with the investment grade names. You know, the well, not the Walmarts, but the Vodafone. Walmart they are an investment grade name, but not in the Greensill program. But this was, you know, the Vodafones, the General Mills, the Airbuses. That business, the way it was structured, was not misdescribed, and could not have been, or they couldn't have got away with it if they tried, because you had very experienced investors, banks in this case, looking at those programs. The problem is that, and that's where Greensill started. So Greensill started in that business because of personal relationships between the founder and some of the names. I think especially in the case of Vodafone, you know, they got a stable of names that other banks couldn't get, and I think everyone was very impressed with how he was able to attract those names to his business. But that business was structured in the way these sorts of funds have been, these sorts of programs have been structured for many years through these rather ponderous double trust or assignment structures involving John's Bank, usually in some form, often as as trustee and paying agent. All very safe, right? Very high volume, very low margin, and not terribly attractive. So those people who wanted the higher returns were attracted to those good news stories, as Thomas described. Undoubtedly, they've been led up the garden path in some way. But I have to say this: I think to some extent they have themselves to blame. You know, you need to understand what you're getting into, and they didn't.
Right.
But we'll see how that all pans out, because there'll be litigation for sure.
Right, Sean, thank you very much for that. In the interest of time, we need to move on a bit. We're going to cover this question about due diligence on the funds in the next topic. Very quickly, do you, Monica, have any 20-second comment on Abengoa?
Well, yeah, Abengoa is a much naive case because Abengoa made its suppliers sign an agreement or an acknowledgement stating that they will be included in this program with a better price for funding if they accepted to extend the payment terms to 180 or 210 days. But without reflecting that in the invoice, in the actual invoice. So the file was sent to the banks, and there was a misrepresentation of what the invoice was issued to be paid at 60 days. And this caused the banks a real problem because many had reinsured limits. And when there was a time to request those claims, and we requested, or the banks requested the invoices, the original invoices from the suppliers, there was nothing to claim because the payment should have been done, or the claim should have been done 120 days ago. So
right. Thank you.
That's a real problem.
Thank you very much for that. Let's turn to the other side of the discussion. We talked about fraud being one of the issues to deal with in terms of understanding payables. Let's talk about the credit underwriting aspect. Was there sufficient credit underwriting at Greensill? What is the best practice to achieve that? John, can you give us some insights on this?
Yeah, thank you, Tony. Just to follow up on Tom's conversation, when we talk about payables finance, it's generally short term. It's matching the commercial terms and conditions generally in the market from an industry point of view. So the example Monica raised with Abengoa, what are industry terms? So are we, to Tom's point, extending the buyer need for longer term financing and the supplier's need for short term financing? generally the payables finance, when looking at it, some things to take a look at that don't necessarily smell right is if a company that manufactures something that has a high turnover and short cash conversion cycle should not be looking at 180-day financing. And so those are some of the things to take a look at in terms of terms. But at the end of the day, it's an obligor risk. So what is the financial results or review? What due diligence has been done on that particular obligor? Do they have the cash flow to meet those needs? Or are they looking at, where's the potential debt, the debt versus cash flow? Are they able to make the payments in the timeline to meet the terms that are being discounted on the receivables? The other side of the coin is it should be a commercial contract. So there are some risks on the supplier side as well, ensuring that as a funder, you are perfecting your interest in the receivable purchase. There's an actual transaction completed between a buyer and a seller. So looking at those components is very important. Again, the due diligence on the financial analysis of the obligor should always be foremost in terms of underwriting. When you look at some of the programs that were in some of these Greensill and others, there were some very good names, very well structured, looking at the documentation, ensuring there's a commercial contract, perfection of the invoices, and it also allows you to mitigate your risk and support recovery to a much larger extent as well. So there's, in terms of underwriting, the funder should be looking at how am I going to get my money back, and whether it's through insurance, whether it's have you done the proper perfection, have you done the proper financial analysis, the documentation, what reps and covenants with respect to the information that was provided on both the buyer side as well as the seller, the supplier, and ensuring that one understands all components in the contractual arrangements when doing this funding.
Thank you very much. Any comments from anyone else on the credit aspects that John just mentioned? Because if not, we can move on to how Payables Finance providers, investors protect themselves against fraud under different models. Now, there are different models. There's the bank-sponsored model, like Citibank was an example of, or is an example of. The non-bank, or the shadow bank, as it's being called, would be the Greensill. But there are also other forms. There's the procure to pay, which is gaining prominence now, where e-purchase orders, e-invoices, and a button you press for early payment. That's also a form of reverse factoring. And then there are the invoice auctions like LiquidX and Income Lend. So the question I'd like to ask Sean is, what are the different risks under these different platforms? Are certain platforms riskier than others?
Yeah, I don't think it's right to say that one platform is riskier than another. I think you need to, again, goes back, the basic point is that you need to understand what it is you're buying, who you're taking the credit risk on, and how that's mitigated. Now, having said that, it's perfectly true that the way that risk is packaged and mitigated is different, depending on the type of model that you're using. I think one of the issues with a lot of the supply chain funds in Greensill, and here I'm talking about the Credit Suisse funds rather than the investment grade business we were talking about a while ago, is that there was a mixture of payables and receivables. And there are very different risks, because a payable is essentially, one way of looking at it is to say it's a perfected receivable. There's no performance risk, there's no supplier risk. And that's one of the big plus points of doing payables or reverse factoring programs, that you remove that. You also create an extra risk. I think we're going to talk about it later, but you've already mentioned the accounting treatment. So the moment you start to actually mitigate against that risk, which in payables finance is done by the provision of an IPU, irrevocable payment undertaking, from the buyer, which is very, very much like a promissory note, an unconditional obligation to pay, you then start getting into trouble on the accounting. but it certainly gets you out of trouble with the, with one of the biggest risks in supplier finance, and something which Fitch in their recent report, I think we'll talk about it maybe a little more detail in a while, but the risk that they saw as a supplier risk. Now, it's also important the type of program that you're using, because if you're using a sort of a Liquidex or an auction platform, there tends to be a sort of a rule book or a common set of standards that are applied to all the parties, and so that's the seller and the buyer. So you're presented there with a neat package. If you're a small bank and you just want to dip in and out of that market, that's very convenient. You just get a lawyer to do a quick whiz through. You don't need to analyze very deeply. Those bigger banks that have analyzed more deeply some of the auction sites have come up with enhancements, that there's certain risks that they don't like, chiefly in relation to cash flow, and protection of that cash flow. So you obviously have a risk when cash is coming back through a seller, and he's your servicer. You also have a risk, of course, when the platform itself is receiving that cash. Generally, the platforms and the arrangers do try to distance themselves from that aspect of the program. It doesn't always work. There's a sort of secret servicer kind of risk, which actually we're having to deal with in Greensill, where although cash, this was a perfectly bankruptcy remote structure, so no problem about that. The fact that Greensill will almost certainly be liquidated and is in the UK equivalent of Chapter 11 hasn't affected our entitlement to the cash flows, but there have been operational risks and delays because in fact they were carrying out various servicing functions. So that's something certainly that that concerned Fitch in their recent report. I think they're right to point it out. So even in payables financing, that risk does happen. We've mentioned some of the legal risks about perfection and notice. Now, in some of these platforms, that job is done by the platform. There has to be a real concern there about whether the platform is doing that correctly. I was just looking at some documentation yesterday for a German platform that actually does something very similar to Albion, in fact, they have reserved the right to, in fact, they ask for a power of attorney to serve notice, which, okay, that's great. But have they done it? Have they done it properly? There are different jurisdictions involved. So the risks do vary. The big divide, though, which you mentioned, to go right back to the slide at the beginning, is between the receivables purchase and the lending against receivables split. And as we've seen in the Credit Suisse funds, there's a bit of both in that, and certainly the future receivables saga, which as I said before, may stop payment under the credit insurance policy. But that's a clear example of where you start straying from what appears on the face of it, from a very casual reading, seems to be a receivable and a purchase of a receivable, to actually something which, and there are many ways of doing future receivables, but in many cases it's simply some sort of unsecured lending with a possible promise, not even security necessarily. I was interested to listen. I think Tony, you did as well, to Lex Greensill giving evidence to the UK Treasury Select Committee on investigating Greensill. Of course, a lot of political aspects, the lobbying aspects. Greensill probably interested the members of Parliament more than the actual structuring of the funds. But one thing which I picked out of that was his statement that actually all of this future lending, these future receivables, were actually all secured. Now, Lex is a lawyer, as I am, and I think I know what he was referring to, and that security, whilst it might exist on paper, it's actually is actually worthless in practice. It's not. It's
Like
not
he talked about houses and property and
Yes.
and you know, intellectual property and inventory and even personal guarantees.
Correct.
But how can you insure something that doesn't yet exist as an asset?
Right. Well, I mean, there's you know, it's security for but that security itself. I think my point is that security itself is very illusory.
Yeah.
And if what you think you are buying is the receivable, yeah, you may have security over the cash flow when it comes in, but actually, if it never comes in, it's worthless. So I think what he's saying is, I have a bit of paper that says what English lawyers call floating charge, i.e., security over everything. In reality, it's security over very, very little, and certainly not what you thought you were buying. So that very basic split between the purchase and the secured lending, very important to understand. Clearly, the lines are very blurred there.
Right.
But
And we'll get to the insurance aspect of that in when we get to insurance. Can I just bring in anyone else in the minute or so we have left on this part of the agenda on this question of the different platforms, and remarking on perhaps what Sean just mentioned?
Let me just make one comment, Tony, because I think that Sean gave an outstanding overview there, and I'm kind of referencing that and referencing the complexity of what Sean was describing there is indicative of how hard it actually is to take platforms and turn them into effective tools of liquidity delivery. The people are forever talking about the fintech revolution and how everything is democratizing financing and working capital finance. It is incredibly difficult and it is minutely detailed work that is required to take any kind of future or a payable or receivable and turn it into cash through the system, and it needs to be worked through incredibly carefully. Anybody that claims they have easy answers or massively scalable solutions and they're coming out of the box today to start is probably, that by itself is a huge red flag. The organizations that are doing this and doing this successfully have been doing it for decades, and there is a reason why, and it is very, very difficult to do. And all of the participants in this and all of the audience in this comment, I hope there's one thing they take away from this. It is that doing these things properly is a very intensive activity that is done by experts and is then delivered based on years of experience.
Right. So that's
Tony,
the perfect. All right, quick one, John, please.
So just to add to that, again, it's not necessarily the platform, it's the structure. So receivables versus payables versus factoring. There are some distinct differences, particularly on the payable side. And platforms facilitate these transactions, but the risk and the potential frauds, the platform may help solve some of them, but the underlying nature of a transaction needs to be looked at most important, as opposed to the platform. They may facilitate, but there are big differences.
Got it. Thank you very much. So just following on from what you were saying a moment, Tom, about getting it right and how difficult it is, let's talk about this next subject, because Greensill was a provider here, an unregulated provider, not a bank, a so-called shadow bank, perhaps, and it packaged things. It sold things under one. Maybe it sold a sheep in a wolf in sheep's clothing. In other words, it said one thing, but it did another. It was a bait and perhaps a switch and bait kind of arrangement, where you're selling great payables, but you're actually doing payday lending or project financing or future receivables. And some people think that, wow, that's just misbehavior. That should be regulated. That shouldn't be allowed. Investors should be protected against this. What are the responsibilities of the arrangers and the buyers in these to disclose and possibly be regulated? Tom?
That's a very important topic, Tony, and it's one to which, however, I have to take sort of an immediate issue with you on a couple of points. The first of which is that of the $7 billion, and let's not quibble about the number because we don't know yet what it's going to be. In some reports already, it's up to 10 billion. The losses that are going to be associated with the Greensill collapse. The biggest component of that arose in the Greensill Bank, and it is the losses that will be suffered by depositors to the Greensill Bank. The Greensill Bank was a thoroughly regulated entity. Okay, so let's not have this notion that Greensill was an unregulated entity. Greensill was a thoroughly regulated entity. In the aspects to which it gets called a shadow bank, that just means it's one step removed from a regulated entity. Orbion is in Germany, we operate under the supervision of BaFin. In every aspect of our business, and this will be true for everybody that's engaged in supply chain finance, I defy anybody to be more than 1 degree of separation from a regulated entity. Okay, in the case of Greensill, where it wasn't the bank, it was the Credit Suisse funds. Well, the Credit Suisse funds are regulated entities. That they are every single aspect of this. There was a firm buffer between an investor or a depositor's money and Greensill. Was at every point of the Greensill capital saga, there was at least one buffer of a regulated entity.
Can I just ask you quickly?
Yeah.
Greensill Capital was regulated as opposed to Greensill Bank?
No, Greensill Bank was regulated. What
Right.
I'm saying is that but Greensill Capital was either getting money from Greensill Bank that was regulated or from the Credit Suisse or GAM fund that were regulated. Okay, so there was no, the only possibility, maybe under a technical sense, some of the funds that were coming in from the Vision Fund as equity investment was not subject to, but that's equity, that's different. That's completely big boys, grown up, supervised, it's everything else. So my point about this is that simply saying more regulation cannot solve for fraud. Asking a fraudster to fill in another form doesn't stop them being a fraudster. They will just lie again. They will just simply, it's not as though they reach a limit and they go, Jesus, I've just lied on too many forms today. I've got to stop. It's time to stop. Well, you've got me, governor. The 14th form today is just too many. And I can't do it. I can't take this anymore. The stress is killing me. That's not the way they operate. Okay. There is fraud, and regulation doesn't solve fraud. In fact, what I would finally say is actually regulation, having entities being regulated can sometimes, and this is not a claim that the industry should be less regulated. I think it is. I think it's very appropriately regulated because of the connections that it has with the banking system. But there is the question that gets asked is, if an entity is able to wave a flag and say, we're a regulated entity, I think that the risk that investors actually do less due diligence than they should otherwise do is a distinct possibility. If Greensill Bank had not been regulated, and I'm afraid I hate to kind of pick on somebody that I'm sure they're very nice and worthy group of institutions, but the Cologne City Symphony, that by reports had $20 million on deposit with Greensill Bank. Had Greensill Bank not been a regulated entity, I doubt that they would have put $20 million or 20 million euros on deposit with them. And even if they were going to do that, because the interest rates seem to be better, they would have asked the fundamental question, which is, how does an entity that is engaged in the notoriously competitive German banking sector, focused on the even more notoriously low margin working capital side of the equation, how are they affording 4 private jets? What's the mismatch here? They didn't do it because it was a regulated entity.
Can we sort of now, that's all very good points on the funding side. We need to obviously go on to the question of disclosure on the buyer side, and whether or not there should be tighter controls there, and possibly some kind of question of materiality. But let's open this to some discussion. did you have any more points on that, Tom, or should we bring in others?
I think with regards to the buyer level disclosure, I would simply say that I think that is going to be a continuously evolving topic. I think that FASB in the US has got a working party that is looking at this very actively at the moment and very appropriately. I think that as products evolve, as the use of products particularly by kind of major publicly listed companies evolves, I think it's thoroughly appropriate that FASB and the other accounting authorities be continuing to take a look at whether they based on the fact that are the accounts in all material respects stating the financial condition of a company, and supply chain finance should be no different from anything else, that it should be appropriately disclosed in a way that allows a reader of those reports to form a firm picture of what a company's financial position looks like.
Thank you. Anyone else?
Yeah, I think
sorry.
All right, sorry.
Go, go.
Can we have ladies first?
Ladies first,
quickly, and then Sean.
No, I just wanted to share with you that the chair of the supervisory board of the European Central Bank, when talking about Greensill in a public hearing, he put as an example two other cases under the German supervisory authority, Wirecard and Commercial Bank of Mattersburg, that were unable to provide evidence of the existence of receivables in their balance sheet. And actually, he attributed these gaps to the rapid expansion of those companies and the fact that they managed long to stay under the radar. So I think that more regulation is not necessary and will harm the business. And in reality, we have to talk about supervisory authorities doing a better job.
Good point. Nice and crisp like that. Over to you, Sean.
Yeah, just two quick points. Firstly, on the buyer disclosure side, is one of the one of the regulators, one of the standard setters, said to me, and a rating agency said to me yesterday on a webinar I did last night for another organization. The likelihood is that we will end up with requirements for more disclosure, but not resulting in full reclassification of the debt. That seems to me to be a fair outcome. But I think what's more interesting, and it ties in a little bit maybe with Tom's point about the degree of due diligence that the Cologne City Symphony should have been doing. These are the guys who are playing their violins and violas and trombones and God knows what. That's what they should be concentrating on. What they need to rely on, of course, are professionals advising them. The interesting point that was made to me is, of course, if you have that degree of disclosure, you can actually trust, if it's the right word to use in the case of rating agencies, but you can trust the rating agencies to actually reanalyze or analyze, recategorize from their point of view, the balance sheet of borrowers. So, but I mean that's from the buyer's point of view. I think on the question of regulation of the arrangers of this finance, I take Tom's point. What I would say is that there is what Greensill was offering. Of course, it could be and is being offered by banks. They are far less tempted, I think, to because they have fewer internal levels of control. They are far less tempted to get away with fraud. They could do it, but that's going to be the end of them. And there are so many people. It's not just 4 eyes these days, it's about 20 eyes from what I can see, my experience. So it's that. And the last point I just want to make on this is it's perfectly true what Tom was saying, that Greensill Bank is a regulated bank. I would point out though that actually BaFin were the first people to sort of call the whistle on Greensill. They didn't close it down, maybe they should have done. I mean, some of us in the UK remember the fiasco with the Icelandic banks some years ago that were offering, very high rates of interest in the same way as Greensill Bank did. But they did call the whistle on them. Maybe they didn't call it loud enough and quickly enough, but they did get in there. So I'm the last person, by the way, as the head of a trade association, to call for more regulation. But I think you do need to look at this question very objectively.
Thank you very much. We need to move on because we're going a little bit over. We started a bit late, so we'll finish late. as they used to say in University Challenge, I've started, so I'll finish. It was a British TV program. Takes me back a bit. Let's move on to credit insurance. So this obviously, the withdrawal of it was the last straw that broke the camel's back. There were originally 28 insurers. It whittled down to one credit insurer who withdrew coverage about 8 or so months before March of this year, which then caused the implosion. So what is it still? Is credit insurance still a viable credit enhancement or wrap for these types of programs? Is it past its sell-by date? Should there be greater scrutiny? I'd like to perhaps ask Sean to look at this, because you've read the Fitch reports, which are quite relevant here too.
Yeah, so I think, look, the problem is, and going back to this question of regulation, our dear friend Lex Greensill suggested that actually it's the insurers that need to be regulated because they act in a counter-cyclical way. I think the problem was there was over-dependence, as you said, Tony, on a single carrier. But nevertheless, I think that the Fitch report that came out a month or so ago, and ITFA did a response to this. And in fact, we have a meeting with Fitch next week to talk this through. What I will say about the rating agencies, they are very open to discussion, and actually had a very positive response from them when we asked for the meeting. But I think essentially what they're saying is what you've got in supply, and here this is in relation to specifically in relation to the funds that Credit Suisse and GAM created, rather than the more sort of corporate. Than the corporate business that we're talking about with the likes of Vodafone and Walmart and General Mills and so on. And what they're saying is essentially, look, you are taking an illiquid asset and you're transforming it. Not only are you transforming the credit quality, but you're transforming the liquidity of this underlying product, which, as we've already said and discussed at some length, unfortunately was rather opaque as to precisely what it contained. But you're taking this wrapper, and essentially, to use an English phrase, you're gilding the turd. There is it's a pretty bad asset, but you're putting this nice bow on it, and you're saying, well, now it's a great product, it's investment grade. So their view is that there is a problem with that conceptually. There are specific risks with the fact that credit insurance terminates, is not in sync, if you like, with the maturity of the underlying payables or receivables. There's the reliance on third parties, which I think is, as I've just mentioned, about on suppliers, and in the case of Greensill, I've talked about the sort of the secret servicer risk. So they don't like this at all. It's quite a detailed response back that we've produced. I think essentially what you remember a couple of basic things about credit insurance. I mean, first of all, it's a very powerful product, but it's a product that has terms and conditions. A bit like when you buy anything. And the nature of this market is that coverage for these sorts of products has expanded enormously. My own experience with the carriers is that they do understand the product, they understand what it is, and they are responsive to the commercial requirements of the parties. These are risks attaching policies, so provided that the risk has been properly described. Again, we go back to this future receivables risk and the problem that actually the policies may well not have covered those. But if the asset or the risk is of a type covered by the policy, that risk will attach and it will pay after the end of that policy. So if there are payments that need to be made under the Tokyo Marine policy up to the date of termination, they will have to do those. They will have to make those. The reason the funds had to close down is because under their rules they could not continue without a proper risk mitigator in place. In this case, the insurance policy. So it's not that the insurers suddenly withdrew or changed the nature of the coverage. It's that the funds themselves legally, constitutionally, if you like, couldn't carry on. Is it right? The bigger question is it right to sort of gild the turd? I mean, I would say yes, it is, because actually these are not turds. There is a, you know, and I mean, some of them may be turds, but they're not all turds. And there's absolutely nothing wrong in structuring and using credit insurance to improve credit quality. Again,
yes, but is it possible to insure future receivables?
It is possible, provided that that is what your policy says. I mean, essentially, what your
that's tautological.
Yeah, I mean, the question you're asking is, can you insure unsecured lending? And the answer is yes, you can. But don't expect that to be the same kind of policy on the same terms and paying the same premium as you would do for a receivables purchase policy. Yeah, they're different risks for investors, as we've discussed ad nauseum. But they're very different risks also for the carriers, for the insurers. So I think it's a slight overreaction by Fitch, but anyway, maybe we'll report back and let you know how that meeting turns out.
Thank you very much. Anybody else on this for the insurance issue? All right, let's move on, because we're slowly reaching our final moments here, and we have some really good questions. So credit insurance we've dealt with. Let's move on to data science, AI, blockchain, and technology. So the world is moving obviously away from paper, moving to digits, e-invoicing, electronic bills of exchange that it is moving to make more ubiquitous, or actually to exist. Is technology going to help prevent the misbehavior and potentially fraud in this field of payables finance, and frankly in factoring as well? Or is this really an illusion? Let's ask Monica to kick off on this, and then have everybody quickly respond.
Okay, well, actually it can, but certainly we are still in the first stages of this potential. In machine learning is a technique that allows computers to recognize a pattern and a trend and generate predictions based on those. But to obtain that pattern, you need to feed it with historical data. But not only with historical data, also with a lot of examples of fraud. So the algorithm can create a model. And once you have a model, it's actually specific for that business. So we are talking about supply chain finance, and our customers could come from a myriad of different business sectors. So that means that your machine learning will take years to have a predictive model that is reliable. If you request historical data from a client to create that pattern, how can you make sure that your client is not giving you a Trojan horse with invented historical data? The major problem actually that the most banks face is that their investment in infrastructure security has failed to keep pace with the efforts to provide the digital services that customers expect. But they have invested heavily in IT security to counteract threats from malware or viruses, but not so much in areas as behavioral analytics that can help detect unusual patterns that could indicate criminal activity.
Right.
It's funny. Sorry. Yes. It's funny that in Greensill, actually, in their webpage, they said that they use enhanced analysis through machine learning, and that this augmented analysis they could protect global companies and governments from the threat of fraud, of money laundering, cybercrime, and terrorism. So actually, something didn't work.
Yeah, it didn't work because it probably wasn't quite as much there as they perhaps suspected.
Yeah, if what we hear in the news is true and there is a major fraud from the lack of real invoices, then something went wrong. Maybe they didn't actually have this artificial intelligence, or their historical data was compromised. When a company grows so fast, its historical data does not grow in a sustainable manner. And the algorithm
certainly when Greensill was up for sale on the basis of being a technology company, there weren't a hell of a lot of buyers. It was really Tolia that was the closest thing to technology, and eventually it went bust. Anybody else on sorry to cut you off, Monica, but we have to move on.
Okay.
Anything else on digitization? I think, Tom, you talked about, an arms race here last time we spoke.
I think that's right, and I think that the good comments that Monica just made there. I think first of all, just very quickly on the green stuff, that it's just as much a component of fraud to claim that you have artificial intelligence and machine learning when you don't, as it is to invent an invoice that doesn't exist. I mean, either you're telling the truth to people about what you're doing, or you're not. And if either you have something and they clearly didn't, and very few people actually do. It is proving very big. Just to Monica's point, the behavioral science around this is really difficult, and identifying patterns of behavior from the past. You can take vast reams of information at the moment, gigabytes, terabytes of information, and it is barely able to move you from the old rules of thumb around factoring that you borrow with recourse and you're given 80% advance. It's all still within that field. So no one should be, and people should be very dubious about that. But the other thing then is that this is going to be an arms race, and just as technology may over time is going to help us to identify fraud, just as banks are increasingly able to have their two-step authentication process and everything else. Similarly, however, technology is enabling the fraudsters to do more and more. Things like ransomware, didn't exist a few years ago. They exist now because of the advances in technology that have allowed those to happen. So technology is certainly never going to be an easy win. It's just going to be, as I say, an arms race for these things.
Right. Now, we are actually very, very close to the end now. So I want to cover, out of respect to our audience who've been incredibly patient and are hopefully excited about what they've heard. There's lots of interesting questions here. Spiros, you're going to have to tell me how much time I have to ask these and have them answered. Maybe you can tell me that on the side chat. But let's start with the first one. On Payables Finance, what are your thoughts on supplier financing arrangements that state that the supplier has to repurchase the receivable if the buyer doesn't pay, or that purchase or financing is with recourse to the supplier? Aren't these contradictory?
Let me answer that very quickly. They are, if there is recourse to the supplier in the event that the buyer doesn't pay, that is that's not Payables Finance, and that is inconsistent with a true sale arrangement for the program. So we certainly at Orbion, we don't have any situations in which where the buyer doesn't pay, there is recourse back to the supplier. That would be completely contradictory to the structural essence of what we have.
Thank you. Thank you. So someone had a quick comment on perfection of rights in receivables. Those jurisdictions which have introduced modern online notice-based secured transaction registries, I'm thinking here possibly about Singapore perhaps, which cover all rights in movables, found it easy to integrate such registries with the SCF reverse factoring platform, so that the lender, before processing early payment through the platform, can perform a quick check and registration as part of the integrated solution. That sounds like a sort of due diligence mitigant.
Yeah, it's a great tool where you can do it. I think the issue is the financing that we're talking about is cross-border or international. So if there was a global register of all receivables, of all debts, believe it or not, some people think that that is achievable. If that could be done, we would get in exactly that situation. But yeah, so in certain jurisdictions like Singapore for domestic debts, you can certainly do that. But when you're talking about a lot of the business that the big banks do, there just is not that sort of coverage. Of course, it's a great solution. Yeah, another thing which, but I mean, those are sort of state-sponsored solutions. One of the things, and again, it's a huge subject. I mean, it's covered by this conference. Is when there's one receivables platform to rule them all, whether that's Orbion or somebody else, there will be de facto a sort of a registry that's created, but that day has not dawned yet.
Right, and here's a little friandise, a little morsel to have with your espresso before the end of this conference. A little question here. I noticed that in John's presentation, it says Payables Finance was categorized as off-balance sheet. I suppose this means off-balance sheet in the books of the buyer. Actually, I think it means both, frankly. Does this not depend on the nature of the agreement, on the financial institution and the auditor's view of the payables agreement? Otherwise, what does this off-balance sheet categorization mean with respect to payables financing?
Well, with respect to off-balance sheet, it's really keeping the accounts payable as an accounts payable from a buyer point of view. And that's the auditors taking a look at it. So whether you identify it as off-balance sheet or not, it's not debt. So that the main component is to keep, from a buyer perspective, on payables finance, keep the payables as a payable. The due date remains the due date from the original commercial invoice.
Anyone else on?
Yeah, just on that. I mean, I think John's exactly right, but the person asking the question is also right. The treatment as John says, when we talk about off balance sheet, we mean it's not debt. It's retained as the original payables treatment is retained. The person asking the question is exactly right. Does it not depend on the terms of the structure and the view of the auditors? Absolutely. The fact is that if the sponsoring buyer can't negotiate terms that meet the requirements of their auditors, they probably won't do the program. So it will be sort of a null hypothesis in terms of the fact that, which is why it's very acceptable to describe this as payables financing or off-balance sheet, non-debt financing.
Yeah, and again, depends so much on how you do on what exactly what product you're offering. At SMBC, for example, we've transformed 3-month payables or receivables, but 3-month payables essentially because we're dealing with a buyer into 3-year payables. It's very clear that that is bank debt. Yeah. It's on balance sheet, and it always was. It's on a different part of the balance sheet. That's what the big debate is about. We sort of talked about that earlier, and it is probably the hottest topic at the moment in supply chain finance.
Well, on that note, I have to say this has been truly a pleasure. I hope it's been very informative to all of our participants and listeners. I want to say a very, very sincere word of thanks to Monica, Tom, Sean, and John for the amount of work you put in here, for your insights into this very interesting topic. Look forward to working with you again. Look forward to seeing everybody else again. And thank you very much indeed.
Thanks, guys.
Thank you.
Thank you all.